It is currently 2026. If you don't know how to identify or trade off a fair value gap or an inverse fair value gap, well, you're in luck. In today's video, I'm going to go over everything on how to identify, trade off, use strategies, and become profitable using fair value gaps and inverse fair value gaps. So sit back, relax, but pay attention because I'm going to have a lot of detail in this video. All right, guys, so we're going to go on to TradingView here, and I'm just going to talk through the most basic things first on basically what a fair value gap is for those that are dead new to trading. You've probably heard about fair value gaps before, especially if you're into trading, you probably do know what fair value gaps are, but I'm just going to run you from the beginning. So imagine we're in an uptrend, right? We're in an uptrend and we've got some candles here. Sorry about my drawings, but yeah, so we've got this uptrend, right? You can imagine all these are candles. All right, so we've got that here. So these are three candles, right? Three bullish candles. So a fair value gap, all it is, it's the in between the first and the third candle, it's the body. It's not the wick, so the wicks aren't overlapping. It's just the body. So as you can see here, to simply identify it, I like to use a rectangle. Some people like to use lines. But here's the fair value gap, because in between this candle and this candle, we've just got a body. And these two wicks are the start and the end of the fair value gap. So this starts the fair value gap from the first candle body wick, and the third candle body wick down is the end of the fair value gap. So anything in between here is the fair value gap, and vice versa, right, guys? So say we're in a downtrend, right? Say we're in a downtrend. We've got three bearish candles here. Apologies about my drawings. This would be a bearish fair value gap. So that was the uptrend. This is the downtrend now. This becomes the bearish fair value gap because we're trending down. So that's also a fair value gap, but we're actually going to make this bearish. So we're going to make it red. So this is the most simple way to identify fair value gap. A lot of people get really confused. I know I was confused when I first learned trading, but it can't get much simpler. You just can't overthink it. It's literally, think of three candles, right? Three up candles or three down candles. The middle one's going to be where the fair value gap is. And the wick and the top wick and the bottom wick of the first and the third candles is where the fair value gap starts and ends. So how do we use fair value gaps, and why are they important, and why do so many traders talk about them? Well, I'll tell you exactly why. The reason why so many traders talk about fair value gaps is because they're a liquidity imbalance on the chart that is most likely going to get filled and you can use to take trades off. So for example, if we move to the charts here, right? We'll come to the charts, and we had a few bullish fair value gaps here, right? On NQ. This is just on the 1 minute. So this isn't even on the 5 or the 15 or the hourly chart. This is just on the 1 minute. So we can see here, all right, yeah, we had this uptrend and we pulled back and then we continued up. Now, why did we pull back? Yeah, we had some kind of fair value gaps in here and here, but we had the main fair value gap here, right? Because what we've had one little candle down here with a wick up. We've had one massive up candle, and we've had another up candle with the wick there. So this is a valid bullish fair value gap. So now, as you can see here, price rallies up, right? Comes back down, taps right into the bullish fair value gap and continues its trend up. This is exactly how traders take trades every single day and make money in the market. Now, a lot of traders will use other things like an SMT, or they'll use a liquidity sweep first, or other confirmations, but a fair value gap is a very important confirmation for you guys to use, because it just gives that extra edge in the market. When you have a fair value gap, when you have a liquidity imbalance and it needs to be filled, you can take some really, really good trades off this. So look what happened here. So say, all right, we were trading and we go, all right, we're going to take it to this point of liquidity here because this looks nice for whatever reason. This could be Asia highs or whatever. We're going to take it to here. All right, well, we're in an uptrend. We just broke out of this consolidation. We had a slight pullback, but what do we have down here? We have a bullish fair value gap. So we're going to take a long the second it touches into that bullish fair value gap, right? And we're going to place our stop just below the fair value gap. Look at that. That would have been a beautiful trade. And that was just an example that I just looked back on. Obviously, this isn't going to happen every time. And obviously, we would have needed more confirmation. So for example, like a trade like this, I would have used something like the Fibonacci retracements and seen, all right, we're in an uptrend. We came up. We came back down to within that 0.618 and 0.786, that golden spot to take trades and optimal entry level. And then we continued higher. And we could have just taken the trade just to here, just to where the previous swing high was. Or we could have taken it up to here. Or look, it kept going up and you could have taken it to these previous daily highs. So there is so much opportunity to take trades off fair value gaps, right? And it's the same thing when we're trending down. So say we're in a downtrend, right? Say we're here. All right, we're in a downtrend. Look at this. Bearish fair value gap. We've had a bullish candle up and 2 bearish candles. So this is a valid bearish fair value gap. I draw that out there. I mark this as a bearish fair value gap. Look what happens, right? We come in, we tap into it, and then we continue down and we continue a massive downtrend. It's obviously not going to happen like that every single time. Fair value gaps sometimes get invalidated, and that's when we turn into an inverse fair value gap, and I'll get to that in a second. But a lot of the time, these are actually really, really good points to take trades off. Like, for example, here, you could have said, oh, yeah, I don't know if this is an SMT or not, but maybe this was an SMT at the high. And potentially we also had, it was also time for us to come down for a little pullback. All right, SMT, boom. And then we had a normal bearish fair value gap, boom. Let's take shorts. I'm looking for shorts. Where's some good liquidity? All right, let's take some liquidity down to about this level here. Boom, it would have smashed take profit. So that's exactly how you can trade. You can take trades like that purely off fair value gaps. Although I don't recommend it, and this video is just about what a fair value gap is, you definitely need other confluences to take trades. It's a very good option, and a lot of traders do this. A lot of traders will use a liquidity sweep and then an SMT at the high, and then a liquidity imbalance, and then they'll have equal lows at the bottom, and then an entry model to use is the fair value gap. It is very popular, guys. So I'm hoping you guys are keeping up with me. If not, go back to the start of the video and try to get your head around these if I'm moving too fast. But yeah, so that's an example of a bearish fair value gap and a bullish fair value gap in context. Now, let me get to something a little bit harder. Let me get to inverse fair value gaps. Now, if you're just getting your head around normal fair value gaps, definitely write all this down with pen and paper if you haven't really got it yet, because I don't want to skip ahead too much for those that are just learning trading. I really want to go slow with this, but I also, for the ones that already know what this is, are just trying to get used to it, I want to explain a few more things. So, all right, what do we have here? We've got slight consolidation, right? What do we have here? So we've had a bullish run, and you'd think, all right, that's a clean fair value gap there, right? That's a clean bullish fair value gap. You'd think that it would react off it, but it doesn't, does it? It keeps coming down. So now what this becomes, right, this zone is inverse fair value gap. And you can see here how it's flirting around this zone. It's kind of tapping into it, tap, 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 tap. And then look what happens. It comes down all the way down there. Now, I'm not sure off the top of my head why this came down, but this is an example of a bullish to switch to bearish inverse fair value gap because it got invalidated. So I'll draw that out there. And you could take a potential short off this, right? You could take a short and you could have taken it all the way down to here, just off this inverse fair value gap. That's how powerful they are. And a lot of traders nowadays are preferring to trade inverse fair value gaps because it shows even more potential in the market to move in the opposite direction. Now, I'll have a little more look here because I normally take fair value gap trades on the 5-minute time frame. I find that is the most beneficial and the easiest way to get W's on the chart. So, all right, boys, so we have a really good example of a trade that I would have taken. I did not take this trade, but I would have taken this trade. This was a few days ago, Tuesday the 13th of Jan, so about 9 days ago. On the 5-minute time frame, right? So if we zoom out a little bit, we've obviously been consolidating on the 5-minute time frame. Like, we're swinging up, we're swinging down, we're swinging up, we're consolidating a little bit, we're swinging up and down. We've got some weird price action here. So anyway, before any of this happened, this drop, we came up, we came strong. That's a strong 5-minute candle, right? We wicked into this bullish fair value gap here. So we'll mark that out for you guys. So that's a bullish fair value gap. That was very strong. And we came all the way up to where liquidity was up here. Now, I want you to pay attention to what happens here, right? So we've obviously got heaps of fair value gaps. Bullish fair value gap, bullish fair value gap, bullish fair value gap, bullish fair value gap, bullish fair value gap. The reason why I don't have this one marked and I've got this one marked, right, is because this one didn't give us a valid entry. So I would have marked this out and I would have waited for a trade to happen up here. However, it didn't. But what did happen is before this candle, right, we invalidated this fair value gap and we wicked all the way down here. Then we crept back up into this inverse fair value gap. And it's an inverse fair value gap again because it was a bullish fair value gap, switched to bearish because the bearish candles invalidated it. Now, this is a perfect entry opportunity, and I'll tell you why. We've already invalidated this one up here. We've invalidated this one. We've had strong force to the downside. The buyers are trying to come back into the market. Now, this is a great time for a bunch of sellers to come in and take a really nice short. So if you could see here, this probably came down all the way to these lows here, and you can see that clearly. So you could have got a 1 to 6.49 purely off a trade like this, or even more if you just took it off the inverse fair value gap as a stop, 1 to 12. That would have been a crazy trade to take. And I'm telling you, there are plenty of opportunities in the market to take inverse fair value gap trades like this. Fair value gaps are good, don't get me wrong. I like them. I've used them my whole life that I've traded Forex and futures. But inverse fair value gaps and trading NASDAQ just go hand in hand. They work so well together. So if I could really recommend something, it would to be get down a strategy. Get a strategy where you either choose a liquidity sweep and then after a market session get swept and then look for an inverse fair value gap and then take an entry. Something like that. But if you're taking entries, the key part of it is either fair value gaps or, like I just showed here, even better, inverse fair value gaps. They are the best thing and they will help you so much with your trading. So take a screenshot of this trade if you would like, or take a photo on your phone just so you can model a trade like this off me and these charts, because it helps your trading so much. You will become so much more profitable if you're not already. Anyway, boys, hope you enjoyed this video and have a good weekend, and I'll see you in the next video.